Welcome to Beat the Markets.
I'm Ritger.
And I'm VKM. So Richter, in the last episode, we kind of talked about the problematic position the stock market is in present given the valuation. And this episode is prompted by a viewer of ours that asked, so I buy what you're saying, what am I supposed to do about it? What am I supposed to do? Get out of stocks and sit in cash waiting for the crash? What say you, Richter?
It's a good question. It's you've got a lot of options. There are a lot of ways to approach this problem. We do have a very overvalued stock market. It's on par with 29 and 99 by any metric. So you've got to do something. You can't. You're burying your head in the sand if you don't do anything. Most people will do that. Most people will do nothing. Most people are not worried about their stocks right now. Even if they acknowledge that they're overvalued, they're still bullish, and they'll ride them down. They won't act until it's too late. So you don't want to be one of those guys. You want to act first.
I'd like to spend a little bit of time on this point. For some reason, people have a big problem with, they may have the facts and have the information and they believe it, but they have a big problem taking action on that.
Yeah.
And I think one of the fallback positions when people start thinking along these lines and if they should do something, they say, well, I'm an investor for the long term. And I think that's more of an excuse to not think about it.
Yeah, it's easy to do nothing. It's easy to do nothing, and it's very hard to stand apart. You're going to be alone. If you sell at the bottom, or if you sell at the bottom, you got plenty of company. If you buy at the bottom or sell at the top, you're going to be alone. And you've got to have a lot of confidence in yourself if you're doing something different from everybody else.
And we as humans are probably wired not to.
Yeah, that's dangerous. You're standing out in a field and there are lions out there. You don't have your buddies with spears with you. I mean, we're hardwired to not stand alone.
That's right. So the other aspect of this is that there's a tendency to feel comfortable or complacent now because the threat isn't imminent.
Yeah, I mean, stocks have treated you great. You like your stocks. They've been good to you.
And that's what I think is the problem with the older generation, people that are maybe 20 years older than me. They've just been conditioned and had a good run overall. There've been a few hairy.
Had a great run.
Great run, few hairy moments, but that's just what hasn't killed them has made them stronger in their resolve.
Yeah, they just recovered and have finally, they finally got some cushion. After two nasty crashes in the last 20 years. And it seems like they're just starting to get ahead. And to say sell now, but things are going so great.
So then the problem becomes when, if things turn and the market starts declining and then the fear emotions come, then people become more motivated to act.
First there's denial, and then there's panic. And by the time everybody's panicking, it's too late. You want to panic first.
That's right.
I've not watched Margin Call, that movie that came out a few years back.
I've not seen it yet either.
Crash. I saw a few clips on YouTube last night. It looks really good. I'm going to watch the whole thing.
Oh, Hollywood made a good movie on finance?
I think they made. I can't vouch for the technicals of it, but from what I saw, it looked pretty good, entertaining at least. So there's a scene in there where this analyst stays up late at night, stays at the office late, crunching the numbers, and discovers that this brokerage house is sitting on a pile of steaming mortgage securities that they've got like their warehouse securities that they've been packaging and selling. They're sitting on a big pile of it they haven't sold yet, and the volatility started to tick up, and the whole firm's equity, the entire equity of the firm can be wiped out. And so they call in the senior partners at 4 a.m. The head guy, he's played by an Englishman, Jeremy Irons, great character. He explained, he gets the gist. He says he hasn't gotten to where he is through brains. So it's just through his.
He's a gentleman banker.
Gentleman banker, yeah. And he says you want to panic first. Somebody says, well, you're panicking. He decides to have his traders sell everything at once the next day. And like the head of the trading department says that you're going to set off a panic. Why are you panicking? So I'm not panicking. I'm just selling first, and that's what you have to do.
So I wholeheartedly agree with that premise, that if you're going to panic, do it early.
Yeah.
And it's helped me well in my trading. Also, what I think is helpful in the broader setting here is that let's start giving a framework of how to approach it, because I think a lot of people operate out of a feeling or don't have a framework of how to look at it. So we've made an assertion that the market is overvalued and it's most likely not going to end well.
That's right.
So there's some actions you may want to take, and very crudely we can say sell it all, but that's problematic for many reasons. One is people are uncomfortable selling it all, and I think rightly to some degree. The other thing is it doesn't give them a framework of when to re-enter.
That's right.
So I would like to.
One-off calls are just, you can listen to somebody who sounds like he knows what he's talking about. He tells you what to do. Well, he doesn't tell you the next step. He doesn't.
Right, and that's the whole problem with tips in general.
Yeah.
That they can tell you when to get in, but no one's calling you, telling you when to get out.
Right. You've got to have a level of understanding for yourself so that you can manage things going forward.
So let's
know why you're doing what you're doing.
So let's start with that. I think you've made a pretty good framework with what we call the Richter Allocator. Why don't you tell us a little bit about how that works?
All right. So the Richter Allocator is something I came up with. It marries the John Bogle's rule of what fraction of your portfolio should be in stocks. Well, Bogle said 100 minus your age. I don't know if it was originally Bogle, but he gets credit for it. 100 minus your age, that's your percentage in the stock market. It's a good rule of thumb. It's better it'll keep you out of having a horrible drawdown when you're 80 years old, but it doesn't do anything about the problem of it addresses that your exposure to market risk, your real world, the life impact of market risk changes with your age. That's what it adjusts for. It doesn't account for valuation though. It's completely agnostic about valuation. So I just came up with a little very simple, as simple as I could make the formula, that it marries 100 minus your age with 110 minus 110 because I make allowance for valuation.
Okay.
So that it's because I'm making an allowance for valuation, I'm going to keep people out of the worst situation, because those situations always arise from an overvalued market. A market that's fairly valued has never fallen 70%. A market that's cheap has never fallen, well, cheap has never fallen 60%, say. Your real bad experiences always start from an overvalued market. They just have further to fall. So it scales you in and out of stocks. It's just simply your stock bond allocation, and it scales you in and out according to your age and according to valuation relative to a long-term, the long-term mean. And I use price to sales for my valuation indicator, though it would work just the same with market cap to GDP or Tobin's Q or the Shiller PE. They all are going to tell you the same thing. If you wanted to get real sophisticated, you could put them all together. You can make an amalgam, and you could say, all right, it basically says. So how it basically works is you take a young guy is going to have a default position of a much higher equity allocation, but that position is going to scale up and down with valuation. So a young guy in a cheap market is going to have the very highest allocation. An old guy in an expensive market is going to have the very lowest allocation, and everybody else is going to be in between. So it works. I've tested it back to 1973, and its long-term rate of return is higher for everybody but a really old guy who's super conservative. Like an 80-year-old guy he's just lagging the market right now, but
But the benefit is that it gives a lot less volatility.
There's far less volatility. Like that 80-year-old guy's worst experience, worst drawdown was in the bear market in 1974. He lost like 14%. In the bear market, the dot-com crash, and in the bear market, the last bear market, he was up because he had no stocks going in. He was just in bonds, and bonds went up. So this model right now is telling you to completely, for the last 2 years, it's been completely out of stocks for everybody.
So let me interrupt here.
Yeah.
Two points I'd like to make about the Richter Allocator. One is it's impressive that using that methodology, it took you out of the stock market.
Took you out of the stock market in '99 and 2000, and then it crashed, and it got you back in.
And
it scaled you mostly out by the next crash.
And the other point,
it got you back in.
And the other poignant part is that there's been very few times where the Richter Allocator gives a zero allocation to stocks.
Only twice. The last 2 years.
Only twice in what time frame?
Ever.
Ever, which...
I mean, the price to sales ratio data that I have only goes back to the 50s, but
okay, so
looking, it might have taken you, it would have taken you out completely. We don't have, the S&P hasn't been around since the 50s, since there was no S&P before the 50s, so we don't have a price to sales ratio, but people have approximated valuations for the Dow and for the market as a whole going back to, 1870s. And if you were to use CAPE instead, the Shiller PE instead, or market cap to GDP, I suspect, looking at these things, that it would have taken you out before the crash in 1929, because valuations were so high then.
Okay, so let's stay with the data we have, which goes back to the 1950s.
Yeah.
And so there's been only 2 times where it's had you out of the stock market.
That's right.
Completely, and we're in one of those times right now.
It's only had you completely like maximum exposure to the stock market at the very bottom, 1980 from like 1980 to 1982. The very bottom before this mega bull of the 80s and 90s.
Okay, so if we let's just plug in some numbers. So let's use me. I'm 42.
Yeah.
And the price to sales is 2 something.
Yeah.
So if you plug in the 2 into the price to sales part,
if you go above 1.8 on the price to sales ratio, where we're at 2.1 right now. No matter your age, it's going to spit out 0 for your equity allocation.
No matter what age you are.
No matter
at
what
present.
age. That's
okay.
right.
Okay. So let's take that part for now. Is that we got a 0% allocation for the Richter Allocator.
Yeah.
Now a lot of people are going to have a problem with a 0% allocation to equity.
Maybe I'm just a bear. I don't know.
Well, that's what the math bears out.
I don't mind standing alone. I'll go whole hog, I'll make a decision like that, and I'll just say no stocks above this level, because whenever we've gotten here, sure, we may have gone up for another year or 2, but we've given it all back and then some. So no stocks. I don't care. I'm standing alone.
Well, you have great faith in your model, as I do, and great faith in and you've seen in your life making decisions different from the herd, how it's benefited you. But most people, for whatever reason, have a problem going to 0% equity. And I don't think that's actually the worst decision to make, because having some partial equity exposure, you could say it's a hedge. It's a hedge in case you're completely wrong.
Yeah, it's a conservative position from a different point of view. Not standing alone is conservative. Okay,
exactly.
Fine. Take what I'm saying with a grain of salt. Do your research and hedge yourself. But there are other ways to do it that don't get you completely out. One other model that we've used is we call it the Shiller Allocator. It's very similar, but it uses the Shiller PE. It doesn't take into account your age. It starts with the default equity bond allocation of 60% equities, 40% bonds. It'll have you in that default portfolio during a reasonably valued stock market, one that's not too expensive, not too cheap. When the market gets really cheap, it'll have you go up to 80% equities, 20% bonds. The market gets expensive above a Shiller PE of 22, it'll get you down to 40% equities and 60% bonds. This is just the software we're working with, and it was built a couple of years ago. I think that if it were built today, they might want to include, they may want to make a change to it. There should be another bracket in there for a super crazy market like we have today. Maybe set it at 28. At 28, you're down to, say, instead of 40% where it has you now, maybe take it down to 20. But that's
or
me.
Or that could be the individual could decide where that level that is.
But that works well too. It keeps you out of the very worst experience of having a terrible experience in a bear market.
In the current valuation, the Shiller PE is 29 right now.
It's 30.
It's 30.
Yeah.
So it would have you at 40%.
40% stocks, 60% bonds.
So that's a more comfortable position for most people to be in, at 40% stocks. It's not zero.
Sure.
And it's and say that typical allocation seems to be even I've seen most advisors seem to advise even people who are retiring now, they have their allocations up at 70-60% equities.
Yeah, it's crazy.
And
that's just irresponsible.
And so it takes them down, it cuts them in half, and so it's not gonna leave you unscathed if there's a bear market at 50% drawdown, but it's still effective. Even reducing your equity position to 40%, assuming there's a bear market of 50%, okay, you're gonna lose 20% of that as part of your total portfolio.
That's right.
Which is not fun, but it's recoverable from.
That's right. Here's another way to look at it. Look at your 10-year expected returns from today in the stock market. Forget about how much you're going to lose in the interim. Now, when the market gets really expensive, it sets up the likelihood of two things happening. Number one is a bear market, a crash, losing 30, 40, 60%. And that usually happens within a few years of an extreme valuation being reached. But the other thing that happens, which you can count on, which is far more, you can count on this with a lot more certainty, is your return over the next 10, 12, 15 years. Because the stock market's long-term rate of return, say, is, there are different ways of looking at this. The market has overshot, when it's very expensive, it's overshot its long-term growth rate, which is, call it 5% real. The last 8 years we've had, call it 17% nominal, call it 15% real annualized returns for the last 8 years. So, and we started out from a market that was not cheap. It was just an average valuation. So now we're way above trend line. Like if you draw the U.S., if you draw the Dow going back to like 1870, and put a trend line in, and put your line of best fit, it's going to be like 5% real. Like your 5% compound rate of return is going to match best. Sometimes the Dow is going to undershoot, sometimes it's going to overshoot. When it's undershot for a while, all of your valuation multiples, like the Shiller PE and the price to sales, will be really low. When it's overshot, they'll be really high. And what tends to happen, what has always happened over given a long enough time, meaning a decade, is the market comes back to its trend line. Maybe it just touches it, maybe it undershoots or overshoots it again, but it comes back to that trend line. So you give it enough time to come back to that trend line, and you know what your rate of return is going to be between where you are today and where that trend line is going to be 10 years from now. And right now that's coming out to somewhere in the range of -1 to +3%, call it 1%.
I have another framework for you in this realm. When you're aggregating the stock market and looking at it at this high level, a lot of the numbers don't change that much. So it's almost as if you're looking at the stock market like a bond, so to speak, a 10-year bond, or you say the best fit's 12 years.
That's the way to look at it.
It's a 12-year bond.
Yes.
And so you know what the payout's going to be.
You know what it's going to be.
The only thing that changes is the price, so the price is what's going to determine your end end result.
That's right, because the underlying economy, the growth in the S&P mega cap S&P 500 type of companies, these things don't change all that much. They are really steady. They just chug along. And these corporations are going to be chugging along no matter what happens with their stock prices. And so you kind of know where they're going to be 10 years from now. And so what you do is you compare that rate of return that's going to take you from today's stock prices to where they're likely to be in 10 years. And you compare that to other rates of return that you can get in the market, like from bonds. And right now, your 10-year treasury, what is it, 2%?
2%.
Or is it under?
It's a little more, but
it's still a little
like 2.1, I think.
Yes, it sounds about right. So you buy your 10-year treasury. Maybe if the market's valued on the high side 10 years from now, stocks will come out ahead, but not much. I mean, no way are they going to come out way ahead at 2%. And they're going to give you a lot of volatility in the meantime, that's for sure. So what are you really giving up? There's a sure thing. You buy that bond right now, you're locking in 2%.
The problem is 2% is not motivating to people.
I know. But I would appeal to their greed and say, well, why don't you wait until stocks fall and then lock in 12%?
And then this is the saying. People say, well, at 2%, inflation is. They'll say inflation's 3%. They're picking some number. Yeah. Inflation's 3%, and the 10-year bond's 2%. So I'm losing a percent every year. And my comment to that is, it's better to lose 1% every year than 50% at once.
You got that right.
And the other fortunate thing about the bear market is it tends to be quick.
Bear markets are quick.
So if you avoid it and sidestep it, it's not like you're looking at beating out of the market for years upon years.
No. And to bring it back to these models that we're talking about, they'll tell you to get back in. You check them once a year. Christmas time. All right, so the first trading day of the year, or maybe let the market sell.
Or your birthday.
Your birthday, whatever. Pick a day, one day a year. Just check your valuation multiple, plug it into your model, simple little model, and do what it says. Set your asset allocation for that year. And don't worry about it. Only look at it once a year. You're going to end up so far ahead of everybody else after doing that for many years. It's ridiculous. With no work. But you gotta check it every year, and you gotta do what it says. Right now it's saying scale back on stocks. After they come down, it's going to say scale in, and that's going to feel scary. You're going to stand alone then too.
But I'll tell you, it's much more possible to make that decision to buy in if you've not been destroyed on the way down.
Absolutely, you can have so much more confidence.
Because the problem with buy and hold is it's good in theory.
Yeah.
I mean, it works in theory. I wouldn't say it's good in theory. It works in theory, but it requires you to buy and hold. And if you're a younger person or on the younger side, continue to make the capital contributions.
Yeah, if you're in a 40% drawdown, say, the model's telling you, but you don't even want it. You haven't even looked at your statements.
That's right.
You don't want to think about your portfolio, let alone sit down with it.
It's very difficult to throw what feels like your money into a black hole.
Yeah.
So that's the other thing. One of the earlier episodes we touched upon, you said that, and I agree with you. I said psychology. You asked me is how important is psychology. I said it's very important. You said you think it's the most important thing. And this is sort of giving a framework of how to manage your psychology during this situation, or gives you the tools to put yourself in a psychological stronger position.
That's right. That's right. When it comes down to it, the market is just human beings hurting. It's not rational. They're thinking with this little, the back of their brain, the most primitive part of their brain. They're hurting. It's emotional. It's fear and greed. So you've got to overcome that with. You've got to apply some discipline to yourself. So you use a formula. We're quants, and quant's power is that it overrules the hindbrain. It overrules the hippocampus. It forces us to do the right thing, to do something that we don't feel like doing. So. Let's get back to how you can address the situation. There are a couple other ways you can do it. One is just diversify. Are you not comfortable with the prospect of losing half your money every decade or so? Well, just, you know, give up abandon the the hope of of these outsized returns that you think you're going to get from the stock market over the long run. And the stock market isn't that much better than over the long run. It's only just like 1% or so better than a really diversified portfolio, a global asset allocation portfolio. That means U.S. stocks, foreign stocks, U.S. bonds, foreign bonds, real estate in the U.S. and abroad, and commodities. Just spread your money around meaningfully. And most of the rest of the world is not nearly as expensive as the U.S. right now. So emerging markets are the only part of the world you can really call cheap. Their expected return for the next decade, their expected real return after inflation is something like 6 or 7%. That's not bad. You could lock in 6 or 7%. The world as a whole is more like 4%. That's a little better.
Some of the European countries are cheap.
Some of the European countries are pretty cheap. A lot of things were really cheap a year ago. Russia, Brazil, a lot of these emerging market countries. And they've all doubled in the last year. The valuation worked. I mean, their valuation multiples really compressed. It told you to buy at the beginning of 2016. And in the last 18 months, they've all doubled. So, yeah, you could just diversify out of this most expensive market in the world.
So I think Shiller himself a few weeks back said something along the lines of the U.S. stock market's expensive. He himself says he doesn't necessarily recommend getting out of it completely because it could go higher. But then he said maybe you want to look at foreign stocks with a Shiller. My concern with something like that is it's when the U.S. stock market or the main stock market goes down, or goes to a true crisis, it pulls down the rest of the stock market.
I mean, there's a high correlation among global stock markets. There's no question. Just because emerging markets are cheap right now, relatively cheap, doesn't mean they won't fall if the U.S. falls. They will.
So then it feels. I mean, so over time they'll move their own way, and you'll get that long-term 10-year.
That's right.
Return.
But the biggest benefit of a global asset, a true a robust asset allocation portfolio right now, is going to be the bond component and the commodity component. Because bonds are.
I looked at a chart just today. Mm-hmm. Commodities are as cheap relative to stocks as they were in 2000.
I can believe it. They've taken such a beating, and they're mean reverting. Yeah, it's a funny thing. People don't think about value investing in commodities because they don't have a yield. There are no earnings. There's no cash flow to look at. So you have to look at them just relative to other assets. You know, a pound of copper relative to the average hourly wage in the U.S., that kind of thing. How many ounces of gold does it take to buy a Ford Taurus or a Ford Model T? You got to use some other metrics, or it's just the Dow, the Dow to gold ratio, the oil to gold ratio for those two, where you put a basket together and you compare that to stocks, to real estate, to wages, to the price level. And yeah, commodities are real cheap. So I wouldn't mind putting a chunk, call it 10, call it even 15% maybe of a portfolio in a basket of commodities right now. Doesn't mean the commodities are volatile. They're in a downtrend. They could fall further, but they are mean reverting. So over the next few years, I'd expect them to do pretty well.
So that's one of the other things. I think expectations of a diversified portfolio is that it's not going to take away all your pain, but it's going to dampen the volatility that you get from the equity markets. Mm-hmm. And over time, it's going to give you a better risk-adjusted return.
That's right. That's right. Over time, I mean, if you put together a portfolio like this, it's only half equities, and the rest is bonds, commodities, and REITs, real estate. I mean, you over many 10-year spans, you will trounce the stock market. Over the long run, call it 50 years, the stock market will probably beat you by 1% or so. But 50 years is not really a realistic time frame. It's not a meaningful time frame.
Right.
So
the other framework I have for this, and it comes from the movie Tin Cup, which I attribute as one of the.
I still need to watch this.
One of the things that changed my life, and the framework basically is, and you know, I have a distaste for the way the general mainstream media covers the stock market and covers investors. It's almost like a contest that they have to beat the S&P every year.
Nonsense. Even Morningstar does this. They rate funds based on 3-year performance.
And so it's this idea that there's that legendary fund manager Bill Miller who beat the S&P every year for multiple years until he got crushed in '08. But the idea is that you know, these guys are good investors, and every year you need to be the S&P 500. And the relation to Tin Cup is that, well, you know, if you approach the game of or the professional golf with the goal of winning a tournament, maybe you take some undue risk, take chances that you ought not to have. Or if you approach the game, this is not what the movie's about. It's the way what I took out of the movie. But is if you approach the game as consistently coming second, third place, consistently having good returns, you're going to put together a great life as a pro golfer or a great cumulative return in the stock market. You're not beating the S&P 500 year in and year out.
That's right. That's right. That's such a bogus benchmark. It doesn't matter. What does the S&P matter to your life? Measure yourself against, I don't know, 60-40 portfolios, or it doesn't. Forget benchmarks entirely. They don't matter. Just look at the progression of your portfolio towards your life goals. That's what matters. Maybe 4% is all you need, and you just need to make sure that you get that 4% over the next 10 years or 20 years. Maybe, maybe it's a higher number, but it's your number, and it's completely. The S&P has nothing to do with that.
I think you're touching on a good point. We're running out of time, so we'll begin wrapping it up. But you're touching on a good point. The idea of benchmarks. I think there's some value in the benchmark, which is that it gives you some basis of measuring performance, and when you're working with people, how do you know who's doing good work and who's not? But
if you're comparing, an equity manager to the S&P over a 10-year period, or 20 even, to make it real fair, because there's a lot of noise on anything less than 10 years.
That's right.
I mean, Buffett can underperform for long stretches.
A lot of the top managers do underperform for long stretches.
Yeah.
But that's and that's why I was getting to the benefit of tossing aside the benchmark is maybe it makes you be more willing to be independent.
Yes.
And that's sort of the problem with how a lot of investors approach the market. What we're saying is not rocket science, and it's nothing that a lot of people don't know. But how many people are truly willing to be independent? Yeah,
a lot of people just have a knee-jerk reaction against market timing. They say, "Oh, market timing, you can't do that. That never went. That never."
Well, all those smart guys said you can't do it, so who.
And all these academics, a lot of academics over the years have come out and said that market timing doesn't work, and they try to prove it one way or another. I've never seen a real proof of it because it's so clear that certain methods of market timing, very simple ones, are highly effective. They're really robust. You can change. It's not like you find some magic number like, okay, you sell stocks if they're beneath their 10-month moving average. People say, oh, that's just an artifact and a statistical artifact. No, it works with 6 months, 7 months, 8 months, 15 months. It's just the fact that you're not in things that are falling and momentum is real. Valuation. How could scaling back out of an expensive stock market not work? How could scaling in, getting aggressive into a cheap market not work?
So this is, maybe this isn't the purview of this discussion, but this is my fear of using the Shiller P on the peripheral economies, because if you're in the main economy, you will revert to the mean. But if you're saying in a peripheral economy and things are getting cheaper and money's flowing out of the country, and then say, for example, in like the 1950s, 60s in certain country, I think it happened in Egypt, and the whole economy gets nationalized.
Yeah, that can happen. That can happen. That's why you got to diversify out of one. You don't want to be all in one country, even if it's the U.S. But yeah, if you're playing, this is Nevin Faber's game, really. You look at the whole. You look at stock markets around the world, and at the beginning of every year, you put your money in a basket of the cheapest ones, like the 10 cheapest stock markets around the world. There are going to be some funky countries in there. It's going to be, you know, Brazil last year when, you know, everybody was fleeing and the peso was crashing. And Russia last year, that sure looked bad. There was a war. It's going to be, you know, Thailand after the default, and you know, all these places that sound bad. But it comes back to the same thing we talked about what are you buying in those countries? You're buying their General Electrics, their Exxons. Now, they're not the quality of the management and all. It's not going to be as good as in the U.S. or in Western Europe. But heck, Western Europe can get in here. Developed countries can get in the cheapest basket sometimes. It happens. It happens. And emerging markets can get really expensive. Sure. Like in 2007. Absolutely. Super expensive. So that happens. It's not always emerging markets that are the cheapest. But even if you're buying into these emerging markets when they're cheap, you're buying, what's his name? Faber, the other Faber.
Mark Faber.
Mark Faber, the Swiss guy. He's lived abroad and invested abroad forever. He points out how these mature companies in dodgy countries are actually pretty good investments. They tend to be family run. They're connected with the government.
That's a good point.
Their businesses are actually a lot more stable than you would suspect. And so you're buying at low cash flow multiples there. They're earning cash. And you're not putting it all in one company and not all in one country. And you're compensated for that risk of, you know, a dictator going nuts or some, you know, natural disaster or whatever. Over the long run, you come out way ahead doing this, because those economies are growing too. You're just participating in the global economy.
And I mean that's to the point, is that we can have these fears. I have this fear of going to the peripheral economy and something like that happens, but the data proves out that if you consistently buy cheap equities on a global basis.
You know, you need to be a good gambler and risk, you know, limit how much you can risk on any one hand, because you'll have a string of bad hands sometimes. But that's
such is life.
That's how it goes.
You have anything more you want to talk about in this particular episode of how to practically apply the information that the U.S. stock market is a dicey proposition?
All right, I'm repeating myself, I suspect, but I'm going to say educate yourself about market history. Bring up, you know, use Google Charts. I love Google Images for this. I search for a chart like long-term Dow chart, historical Dow chart, Shiller PE, long-term, price to sales ratio, long-term. And just look at these charts. Be familiar with what's happened in the past.
Well, I'd say you'd want to probably do ratio charts, because it puts it in perspective. If you just take a Dow chart alone, how do you interpret that?
You want to look at the valuation ratios. You know, go to the site multiple.com. Just Google the Shiller PE. That's one you can always find, or CAPE. And just familiarize yourself with how to value the stock market. It's so much easier than valuing an individual stock, and so much more reliable if you give yourself that 10 years, which is all that matters. So educate yourself, learn what I'm talking about, and then have some confidence to be different. Come up with a plan. No matter what in investing, you have to have a plan, because we're all idiots. This part of our brain is going to ruin our returns. So you have to write it down, have a written plan. Nobody has a written plan. Have a written plan, commit to it, make it really simple, and follow through. Do what it says, bite the bullet. You're going to stand apart at key times, and that's how you win.
Well said.
All right, that's a wrap. Thanks for listening.
Thank you for watching.
Don't forget to like and subscribe. We'll see you next week.